If you're thinking about buying, selling, or trading a Harley, don't ignore what just happened to the company's stock. Wall Street suddenly turned more optimistic on Harley-Davidson, even while dealers are still carrying months of unsold motorcycles, and the company is coming off a painful financial quarter. Investors are beginning to price in the possibility that Harley can reduce inventory, control production, and rebuild its margins before the showroom numbers look healthy again. So in this video, we're separating the rally from the reality. What actually triggered the move, whether the recovery has real evidence behind it, and what it could mean for the price of the Harley sitting in your garage. Watch till the end, because the real Harley story is in the numbers. What's happening? The financial reporting for the fourth quarter of 2025 delivered a stark reality for Harley-Davidson. The company confirmed a net loss of $351 million, which translates to a loss of $2.44 per share. Investors rely on these quarterly disclosures to gauge corporate health, and this specific figure stood in contrast to market expectations for performance. A net loss is fundamentally different from operating weakness. It indicates that after all costs, interest payments, and taxes were settled, the business consumed cash rather than generating it. While some volatility is common in the manufacturing sector, a loss of this magnitude signals a profound mismatch between the company's cost structure and its current sales velocity. Market participants reacted with significant unease because this result suggests that the company's internal controls and revenue generation are not keeping pace with external economic headwinds. When a heritage brand reports such heavy losses, the stock market typically reassesses the long-term risk profile of the organization. The primary question is whether this event represents a temporary reset, where the company sheds excess baggage to find a new equilibrium, or if it marks the beginning of a deeper, more structural deterioration. For the everyday rider, these corporate figures are not abstract. A manufacturer under severe financial duress faces constraints that ripple outward. Dealership support, the availability of specific replacement parts, long-term service confidence, and the projected resale value of the motorcycles already in garages are all linked to the company's ability to remain solvent and stable. Turning toward the core of these financial results requires separating pure sales figures from the actual health of the profit engine. Profits got crushed. Revenue figures for the quarter declined by 15%, landing at $1.13 billion. While a double-digit drop in sales is concerning, the more alarming metric was the gross profit, which plummeted by 44% to $226 million. A discrepancy of this size reveals that the company is struggling with margin compression, which is often driven by heavy discounting. When a manufacturer uses aggressive incentives to move inventory, they are essentially trading profit margins for volume. This practice might clear showroom floors in the short term, but it erodes the premium status of the brand and complicates future profitability. It is vital to distinguish between lower consumer demand and lower quality revenue. The decline originated across multiple divisions, including core motorcycle operations and the associated apparel and parts businesses. This indicates a widespread pullback in customer spending rather than an issue isolated to a single product line. It remains an open interpretation whether these aggressive discounts were a strategic necessity to clear older stock or a reactive measure to flagging interest. Regardless of the intent, the consequence remains consistent. For the owner, a heavily discounted new motorcycle placed into the market today places immediate, tangible pressure on the resale values of every similar used motorcycle currently held by private riders. If the cost of entry for a brand new machine drops significantly through incentives, the perceived value of a pre-owned model must adjust downward to remain competitive. This creates a challenging cycle for current owners who find that their assets are worth less than market conditions previously suggested. Beyond the pricing strategies and profit margins lies the logistical challenge of managing thousands of unsold machines across the nation. If Harley's stock move affects your next purchase, like this video, subscribe for clear, evidence-based motorcycle coverage, and share your view in the comments. Was this jump driven by genuine improvement or investor optimism? Your perspective adds valuable context here. The inventory question. Harley-Davidson finished the year with 80,000 unsold motorcycles distributed across its dealer network. This inventory level equates to roughly a 193-day supply, a figure that is widely scrutinized by industry analysts. Days of supply represent how long it would take to sell the current stock if no new motorcycles were produced, based on the current sales rate. When that number reaches nearly 200 days, it signals an accumulation that exceeds the natural rhythm of the market. This backlog creates significant pressure for both the manufacturer and the independent dealerships. Dealers must bear the financial burden of carrying these units, often paying interest on floor plan financing, which is the credit they use to purchase bikes from the factory. As inventory ages on the showroom floor, it becomes a liability rather than an asset. Manufacturers often respond to this bottleneck by forcing promotions, which further pressures the bottom line, or by throttling production at the factory level, which brings its own set of operational inefficiencies. It is critical to separate the motorcycles currently sitting at independent dealerships from the stock held directly by the company. The units at the dealer level are the most sensitive because they directly impact the local business owner's liquidity. If a dealer is burdened with too much aged inventory, they have less capital to invest in parts, service technicians, and the customer experience that heritage riders expect. While a large supply of bikes might provide a temporary buyer's market with negotiating leverage, the long-term impact on the brand is negative. A saturated market eventually leads to a weakened position for the brand's resale value, making it harder for longtime owners to justify the financial commitment of new ownership. The cumulative weight of these financial pressures eventually manifests in the one place that investors watch with the most intensity: the stock market ticker. Wall Street reacts. The equity market responded to these fourth quarter earnings with an 11% decline in a single trading session. This sharp reaction is the culmination of several factors converging at once: declining revenue, compressed gross profits, and conservative management guidance that failed to reassure nervous investors. The stock decline was not driven by any single headline, but rather by the collective realization that the company's previous recovery assumptions were no longer holding weight. Investors generally look for a path toward profitability, and when a company uses vague language like a transition year, it is often interpreted as a lack of a clear, actionable plan. The announcement that a long-standing board member would not seek re-election, occurring just 48 hours after the earnings release, added a layer of uncertainty regarding governance and strategic direction. When the market sees negative financial results paired with the departure of key leadership, it creates a vacuum of confidence. The question investors are now debating is whether the current management team has a credible path to turn these operations around. The test for management in the coming year is whether they can prove that this period is merely a difficult correction rather than the start of a prolonged decline. Margins under pressure. Revenue tells you how much business entered the company. Gross profit reveals how much value remained afterward. That distinction matters because a manufacturer can sell many motorcycles while earning very little on each one. Gross margin is the percentage of sales left after subtracting the direct cost of producing those motorcycles. It pays for administration, engineering, marketing, interest, taxes, and eventually shareholder returns. The reported fourth quarter figures showed revenue falling 15% to $1,130 million. Gross profit declined 44% to $226 million. That gap is the central evidence beneath the headline. Profit weakened considerably faster than sales. The figures indicate that Harley-Davidson retained less money from every dollar of revenue, although the exact contribution from each factor requires management's detailed disclosures. Discounting is one possible pressure. Incentives can move aging motorcycle, yet they reduce the amount collected from each transaction. Product mix can also matter. A quarter weighted toward lower-priced models, fewer premium configurations, or weaker parts and apparel sales may produce less profit, even when unit volume appears stable. Factory utilization adds another complication. When production falls, expenses connected to facilities, equipment, and salaried labor do not disappear immediately. A stronger sales number means little if every unit carries less financial weight. The production trap. A motorcycle factory carries costs that continue even when assembly lines slow. Buildings require maintenance. Skilled employees, engineering teams, equipment leases, insurance, and supervisory staff still require payment. These are fixed or relatively fixed costs. Their burden becomes heavier when fewer finished motorcycles leave the facility. Imagine a factory spending the same basic amount to operate while producing fewer units. Each motorcycle must absorb a larger share of that expense. The result is higher cost per unit, even before materials, shipping, warranty work, or dealer support are considered. That is operating leverage working in reverse. Strong volume can spread overhead widely. Weak volume concentrates overhead across a smaller production base. Reducing output may still be necessary. If dealers already hold excessive inventory, continuing to build motorcycles at the previous pace can deepen discounting and create more financing pressure. Production adjustments can help bring supply closer to actual demand. However, slowing factories also risks lower utilization, supplier disruption, employee inefficiency, and additional restructuring charges if documented by the company. It does not automatically create future profitability. That uncertainty reaches riders through model availability, delivery timing, parts planning, and confidence in future product support. Reducing supply can steady the system, but only if demand eventually meets it. Dealers under strain. The dealer network is where factory production becomes a customer transaction. Harley-Davidson ships motorcycles to independent dealerships, and those businesses then display, finance, market, service, and sell the units. The manufacturer records its own sale according to the applicable accounting rules, but the dealer must still find an end customer. That difference matters when reported factory shipments appear healthier than showroom traffic. Dealers commonly use floor plan financing to carry motorcycles before sale. Interest accumulates while units remain unsold. As inventory ages, the dealer may request incentives, advertise discounts, or negotiate additional support. Those actions can improve turnover, yet they also place pressure on the motorcycle's realized selling price. Older stock may require more aggressive pricing than a newly introduced model. Public information can establish dealer inventory levels when the company reports them. It does not automatically establish that widespread dealers are failing, defaulting, or closing. Such claims require company disclosures, court records, lender filings, or other reliable evidence. Without that documentation, the responsible conclusion is narrower. Elevated inventory creates financial pressure for dealers, particularly when borrowing costs remain high and customer demand is uncertain. When showroom strain becomes visible, the ownership experience often feels it before the balance sheet does. The transition gamble. Management guidance must be read as a forecast, not a promise. It normally depends on assumptions about motorcycle demand, pricing, dealer inventory, production levels, expenses, financing conditions, and currency movements. If Harley-Davidson describes 2026 as a transition year, that language signals adjustment and uncertainty. It does not, by itself, prove imminent collapse or guarantee recovery. The useful question is whether the official outlook addresses the company's measurable problems. Investors need to understand how inventory will decline, how margins will improve, how factory costs will be managed, and whether operating cash flow can remain adequate. A forecast that discusses revenue but leaves those pressures unexplained provides less reassurance than one connecting specific actions to specific outcomes. Previous forecasts also matter. If management has repeatedly revised expectations downward, investors may assign less credibility to new targets. That does not mean every revision reflects deception. Economic conditions change, customer behavior shifts, and dealers may respond differently than anticipated. Still, the market evaluates guidance through its record, not merely its wording. The evidence, therefore, supports caution, not a predetermined verdict. A transition year can describe a disciplined reset, or it can become a recurring label for postponed improvement. The distinction will appear in later filings through inventory movement, gross margin, production discipline, dealer health, and cash generation. Until those measures improve together, optimistic interpretation remains incomplete. The figures establish the pressure, later examines how investors translated that pressure into a market judgment. Stock versus reality. A falling stock price is a judgment about future expectations, not a direct measurement of present operations. Shares can decline before a company reaches a genuine financial crisis. Investors may believe earnings will weaken, demand will remain soft, or management will need longer to restore acceptable margins. Those expectations become reflected in the price before every consequence appears in official statements. Valuation also matters. A stock can fall even when the company remains profitable if investors decide that future profits deserve a lower multiple. Short-term traders may reduce positions after disappointing guidance. Long-term institutions may wait for evidence before buying again. Some investors sell because confidence has weakened, while others sell because their models now assume slower recovery. These are market actions, not proof of bankruptcy. Harley-Davidson's share weakness may therefore be pricing in several possibilities at once. The market may expect lower earnings, continued promotional pressure, weaker dealer orders, or a longer inventory correction. It may also be questioning whether the company can protect its premium position while attempting to stimulate demand. Those concerns can depress the stock even while factories operate, motorcycles ship, and dealers remain open. Market pessimism creates a warning signal, not a final diagnosis. If this breakdown helped you understand why Harley-Davidson's stock jumped, subscribe now for updates on motorcycle companies, market moves, and ownership economics. The next financial report may confirm this recovery or challenge it, and you will want to be ready. The payout question. Dividends deserve careful examination because they represent cash leaving the business. Harley-Davidson's annualized dividend has reportedly declined to 75 cents per share, after reductions totaling roughly one-half over the past 6 years. That history shows management has already treated the payout as adjustable rather than untouchable. It also explains why income-focused shareholders watch cash generation closely. A dividend is sustainable when operating cash flow can support it after necessary investment, debt obligations, working capital demands, and other commitments. Accounting earnings alone do not answer that question. A company can report a profit while inventory absorbs cash. It can also record a loss while temporary charges obscure stronger underlying cash generation. The relevant test is free cash flow, meaning cash remaining after capital expenditures required to maintain and develop the business. Publicly reported results must establish whether the dividend was covered during the relevant period. If free cash flow was negative, that does not automatically mean a reduction is imminent. Companies may use existing cash, borrowing capacity, or other resources to maintain distributions temporarily. However, every dollar paid to shareholders is unavailable for inventory reduction, restructuring, dealer assistance, factory investment, or debt repayment. That creates a strategic choice. Preserving the dividend can reassure investors and honor shareholder expectations. Reducing it can protect liquidity and demonstrate financial discipline. Dividend confidence depends on cash, not tradition alone, leadership and governance. Leadership changes require precise interpretation. A confirmed board member's decision not to seek re-election establishes a governance event. It does not establish the reason behind that decision. The departure could reflect ordinary succession planning, personal priorities, term limits, disagreement, or a search for different expertise. Without a documented explanation, assigning a motive would exceed the evidence. Timing can still influence investor perception. When a board change follows disappointing results, shareholders may connect the events, even if no formal connection exists. Markets dislike uncertainty because uncertainty expands the range of possible outcomes. Investors may ask whether the company needs continuity, stronger oversight, new operational experience, or clearer accountability. Those questions are legitimate. Conclusions about internal conflict require supporting documentation. The more important test concerns the strategy management has stated publicly. A credible plan should identify how Harley-Davidson intends to manage demand, inventory, pricing, manufacturing capacity, dealer relationships, and cash flow. It should also explain what success will look like in measurable terms. Broad language about transformation or transition can provide context, but it cannot replace operating evidence. The boardroom sets priorities. The showroom eventually reveals their consequences. Your Harley's value. New motorcycle pricing influences used motorcycle economics through comparison. When dealers offer substantial discounts on unsold units, buyers may compare those prices with pre-owned motorcycles carrying mileage, financing costs, and fewer protections. Owners then face pressure to reduce asking prices if they want to remain competitive. That is ordinary market adjustment, not evidence that every Harley-Davidson motorcycle has lost its value. Depreciation depends on several variables: model demand, mileage, condition, maintenance records, customization, regional supply, and financing availability all matter. A popular touring model with documented service can perform differently from an overstocked configuration that received heavy incentives. Supply also matters because numerous similar motorcycles competing simultaneously can lengthen selling times and weaken negotiation leverage. Corporate weakness may affect confidence, but its effect on resale values is not automatic or uniform. Buyers may become cautious if they fear reduced dealership coverage, limited parts availability, or weaker long-term support. Those concerns can influence offers. Yet the brand's heritage, established owner community, mechanical familiarity, and existing parts ecosystem may continue supporting demand. Short-term promotions should therefore be separated from long-term deterioration. A temporary factory effort to clear aging inventory can pressure used prices for a period. Permanent damage would require broader evidence, including sustained declines across models, falling transaction values, reduced buyer participation, or service network contraction. Without that data, predictions of a complete resale collapse remain speculation. Ownership economics are influenced by corporate conditions, but they are not controlled by the ticker alone. Proof of recovery. A real recovery would appear first in operating evidence, not in a rising share price. The clearest starting point would be stabilizing retail demand. That means customers are purchasing motorcycles without extraordinary incentives, and dealers are placing orders based on genuine traffic rather than temporary discounts. Shipment growth alone would not be enough. Retail performance must improve at the showroom level. Dealer inventory would also need to decline to a more manageable range. Lower stock would reduce floor plan interest, promotional pressure, and the risk of aging motorcycles. The improvement must come from healthy sales, not merely from transferring unsold units between locations. Inventory reduction achieved through severe discounting could solve one problem while creating another. Gross margins would need to recover alongside volume. Harley-Davidson must retain more revenue from every motorcycle sold. That requires better pricing, stronger product mix, disciplined manufacturing, and fewer costly adjustments. Production should match demand closely enough to prevent another accumulation, while factories operate efficiently enough to avoid overwhelming each unit with fixed expenses. Positive operating cash flow would provide another important confirmation. Earnings can be distorted by accounting charges, but cash generation shows whether the business is funding itself. Investors would also need credible guidance supported by measurable milestones. Dealer confidence should improve through healthier turnover and predictable support. Used market data should show stable or improving transaction values across important models. The market can anticipate improvement, but operations must eventually confirm it. Harley's best shot. The strongest reasonable positive argument begins with inventory control. If production is reduced carefully and retail demand remains stable, dealers could gradually clear older motorcycles. Lower stock would reduce promotional pressure and floor plan costs. Once aging inventory no longer dominates the showroom, the company might regain greater control over transaction pricing and protect gross margins. A controlled reset could also improve manufacturing balance. Fewer units may allow factories and suppliers to operate closer to actual demand. That possibility depends on managing fixed costs, labor arrangements, and supplier commitments. Cutting production by itself does not guarantee profitability. The benefit appears only if supply declines faster than the costs attached to maintaining the operating system. Harley-Davidson also retains a loyal customer base and a powerful heritage identity. Many riders value familiar mechanical character, established styling, community, and brand history. Those qualities may support premium pricing when motorcycles offer clear value and dealers provide dependable service. Heritage products can retain long-term appeal, especially when owners maintain them carefully and view them as more than transportation. Hope has value only when it is attached to measurable operating progress. What riders should know: falling revenue, sharply reduced gross profit, elevated inventory, and uncertain guidance would challenge any manufacturer. Yet one bad quarter does not establish permanent failure. The stock reaction reflects expectations about future performance, not certainty about what management will accomplish. Riders should evaluate motorcycles individually. Reliability depends on the specific model, maintenance history, service quality, parts access, and owner care. Resale value depends on condition, mileage, demand, regional supply, financing, and actual market transactions. A weakened share price does not automatically make an existing motorcycle unreliable, nor does a respected badge guarantee that every model will retain value equally. Investors face a different test. They should watch gross margins, dealer inventory, operating cash flow, production discipline, capital spending, dividend coverage, and guidance execution. The most important evidence will be whether management's stated actions produce measurable improvement across several reporting periods. Stronger revenue without healthier margins would be incomplete. Lower inventory without cash generation would also provide only partial relief. The road ahead remains uncertain, yet the standard for judgment is clear. Results must eventually speak louder than reputation. Harley-Davidson's stock may be climbing, but the real comeback won't be proven on Wall Street. It'll be proven by bikes selling, dealer inventory shrinking, margins improving, and riders feeling confident enough to spend their money again. So what do you think? Has Harley finally started turning the corner, or is this rally getting ahead of reality? Let me know in the comments. If you enjoyed this breakdown, hit the like button and subscribe to our channel for more straight, evidence-based motorcycle coverage.